Today, SEC Chair Gary Gensler says the agency's current regulations still apply to crypto. Coinbase bankrolls a lawsuit over tornado cash sanctions. And Diogo Monica of Anchorage Digital discusses the importance of regulatory clarity for crypto businesses. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Cryptocurrencies bouncing back from yesterday's sell-off. By noon Eastern, Bitcoin climbed back above $19,000, while Ether jumped to $1,600. Uniswap, meanwhile, traded above $6. All right, time for the top stories. First, Coinbase is backing a lawsuit over tornado cash sanctions. The crypto exchange is footing the bill for 6 users of the crypto service who are suing the Treasury Department, which blacklisted Tornado Cash back in August. Tornado is a mixing service which lets users conceal crypto transactions. Treasury argued this particular service was used to hide billions in stolen crypto. The lawsuit, meanwhile, claims the ban harms U.S. citizens who want to engage in entirely lawful activity in private. Coinbase's chief legal officer told CNBC the sanctions set a dangerous precedent, saying any technology or tool could be fair game. You can read that full story over at cnbc.com/cryptoworld. Next, a new report finds crypto mining here in the U.S. uses as much electricity as all residential lighting nationwide. The report came from the White House's Office of Science and Technology Policy as part of President Biden's March executive order on crypto regulation. The study also found that crypto regulation should focus on reducing greenhouse gas emissions, limiting increases to energy prices for consumers, and avoiding impacts to energy grid reliability. Finally, SEC Chair Gary Gensler says crypto already has clear regulation. Speaking at a conference, Gensler said the vast majority of cryptocurrencies are securities and that current SEC regulations apply to those tokens. At the same time, Gensler said that Bitcoin should fall under the purview of the CFTC as a commodity. Okay, for our main story of the day, Crypto World's Jordan Smith spoke to Diogo Monica of Anchorage Digital about the merge, but also what institutional investors want to see from crypto regulation.
Okay, so let's start with the merge. We're about a week away from when the final upgrade is supposed to happen. How are institutional investors thinking about that merge, and what are some of the biggest questions or concerns you're hearing from clients?
Yeah, so we're definitely on the final countdown. September 13th to 15th seems to be the expected date for the merge. There was another successful fork just yesterday that happened. That is another step towards a successful merge. I do think institutions have a couple of interesting thoughts coming into the merge. The first one is obviously excitement in seeing the progression of the Ethereum ecosystem that has actually led, the lack of progress has led some institutions to bet on some other layer ones that have been seen as competitors. Something that is unique to institutions, however, is that institutions, especially very large institutions that have large amounts of Ethereum, are actually pretty concerned about the period around the merge. Obviously, transactions are going to be blocked by all of these platforms and all of these institutional participants, Anchorage Digital included. And there's going to be a period in which it's not going to be obvious where there's actually going to be a fork that emerges. There's going to be a successful merge itself. So there's some uncertainty around it. The large majority of our clients know that they're safe at Anchorage and that we're going to do all the integrations and all the necessary tests to make sure that this goes flawlessly for them. But anyone that has actual Ethereum sitting on a custodial account is wondering whether the platforms are going to support any kind of forks that derive from it and how those edge cases actually work out. That's an interesting angle that for retail is not really a concern traditionally, just because they're on their own wallets. But when you're actually in an ecosystem and you're depending on a third party, there's lots of conversations about it.
Yeah, let's touch on that in a minute, but I do want to talk about selling pressure. I mean, some of the biggest holders of ETH have been selling ahead of the news. Are your clients treating this more of a buy the rumor, sell the news type of event, or is it more that interests from institutional investors will come after the upgrade is done, after we've seen some finality as to what's going to happen with any sort of fork or any sort of issues that may come from this transition?
Anchorage only works with institutions, and we bias towards very large institutions. And the patterns here have been very few of these institutions have actually decided to sell Ethereum. So in fact, they look at this as something that is positive. They're not trying to sell it. Very few of them are trying to buy more. It seems to be, I want to participate in this new consensus mechanism I want to make sure that I'm doing and participating in the proof of stake and also generating return from that is being derived by my Ethereum versus just sitting on a custodial account, but they're not actually making trades ahead of a potential merge. And that is also because we're biased towards very large institutions. The original clients of Anchorage were all the large crypto funds, VC firms, very large family offices. And now, even though we have 37 plus different client verticals, large banks, corporates, et cetera, they still behave in this manner with a very long-term horizon. Their calculus on Ethereum has not changed. If anything, has actually created more excitement around the actual event, and that it's in fact going to happen. And in some cases, the belief that it was going to that does take us closer to a scaling solution using shards, and that this is really just a first step, even though we both know that is likely years away.
There's been talk that the merge could kill off some of the less legitimate cryptocurrencies out there. Do you agree with that? Do you have any insight as to why that might be the case?
No, I actually think crypto fundamentals in terms of price have been proven over and over again, not necessarily have a rational basis for them. There's been many cryptocurrencies and many blockchains that have had absolutely zero utility, zero value, major hacks, and whose price has minimally been impacted by this. So this is a little bit, I like to make the equivalent to cybersecurity 10 years ago, that these large companies would be hacked and then their stock price would essentially not dip at all, as if nothing had changed. And so I don't think Ethereum being successful here will somehow take that much pressure, buying pressure, or create sell pressure on these other assets. I don't think that way, just because the communities are very different. The smart contract language is very different. Just the ethos around developers is very different. The focus of some of these platforms are very different. Very different if you're focusing on security tokens or NFTs or remittances or stablecoin settlements. And so that has already become part of the DNA of these other blockchains. So even though you can see them as competitors, it's also like programming languages. Every single programming language does the exact same thing as every other programming language. They're all Turing complete. And even though you can actually do everything on each programming language, there's dozens of them that are incredibly popular because there's an ecosystem around it, because there's a set of frameworks behind it, because there's a set of just like and dislike from the developer's point of view of whether they like this framework and this community and this ecosystem. That will remain the same.
Is there something in regards to regulation that's holding up institutional investment? Is it something around clarity on if it's the CFTC that needs to regulate cryptocurrencies that could drive new institutional players to come to you or come to crypto in general as a means of starting to invest?
Yeah, it's always step functions. The same way that when Anchorage became the first federally chartered crypto bank in the United States last year, early in December, that was a major step function for the industry. Before we did it, there was no federal bank. After we did it, there's an actual federal charter. What that means is that the large institutional players finally had a partner, a platform that is truly a qualified custodian, which is what the SEC mandates that any RIA uses to custody their assets. So there was clarity finally in the space around a clear qualified custodian in the space that can hold my assets, that can actually store them safely and still meet the regulation. The same way that was a step function in regulation, I do think that there are many steps of regulation that are missing. Stablecoin regulation is definitely one of them. CFTC versus SEC jurisdiction, or where the assets actually land if we don't decide on an actual regulator for the type of asset. Maybe we can at least create a clearer definition of where assets actually land in which buckets. And of course, a lot of the other regulation that we don't even talk about that much because they're just newer regulation around NFTs. Where do those land? So what does an NFT mean, and what types of NFT actually are under which regime? That's very interesting. And so there's all of these. Crypto moves so fast that I don't envy the job of a regulator that is trying to regulate effectively a moving target that is not slowing down. Every year we have some major new platform shift. NFTs, we had the DeFi summer, we had the ICO boom, we had Ethereum, we had Bitcoin. All of these things have kind of been a sequence of incredible progress, which is amazing for the US economy, amazing for the space, amazing for the internet, but very hard to regulate.
Okay, that's all for Crypto World today, but we'll be back again tomorrow and we'll see you then.